October 2024 monthly macro webinar, which we're calling Over Easy. Taking a step back, I think there was a real question over the course of the last couple of months about just how aggressive central banks were going to be in terms of their easing cycle. And part of the conversations that we've had in the previous macro webinars the last couple of months has been wrestling with whether or not it made sense for central banks to cut nearly as aggressively as was priced in short rate markets globally. And I think over the course of the last month, we've gotten increasing indications, particularly in the Fed's case, that the Fed intends to cut relatively aggressively in response to current economic conditions, or maybe I should say, despite relatively strong economic conditions. And that combined with large easings that are occurring pretty much everywhere else in the developed world means that we've entered a part of the cycle that is a coordinated global easing. Now, what's unusual about this coordinated global easing is that typically global easing requires a deterioration in economic conditions. Remember, central banks are almost always responsive to economic conditions rather than proactive. And in particular, they almost always cut swiftly in circumstances where economic activity growth is the primary concern, not where you have a moderation in inflation. And so we're getting a pretty unusual circumstance globally where growth is fine and holding up. Employment conditions are still in pretty good shape. And yet central banks are easing aggressively. This sort of over easy policy is pretty unusual in the developed world. We haven't really seen this in the post-war period, and instead is much more common in emerging market economies, where central bankers are often incentivized to provide monetary policy that is too easy given economic conditions. And so, while this set of circumstances that we're seeing today is somewhat unusual for developed world investors, it is not by any means an unheard of monetary policy response when you look at the history of countries. And so, drawing on that experience, I think we can think through some of the lessons and dynamics that are likely to transpire ahead. So what you see here as we kick this off is we have a coordinated global easing. That global easing now we have in September, 21 different countries cut in September. The last time that we saw something nearly as significant was COVID, of course. But before that, the previous time that we had seen such significant cuts globally was during the global financial crisis. And say what you will about the current economic conditions globally, this looks nothing like the global financial crisis. We've also seen a pickup in money supply or money creation globally after a pretty significant decline and softening of money creation, particularly in the developed economies as quantitative tightening took hold. As that's sort of been pared back and other economies like China have provided increasing money supply, we are seeing on a global basis an acceleration in money creation as well. So with rates down and money creation up, we really are experiencing a global easing. This global easing is really broad-based. I'll show a few, or is expected to be broad-based. I'll show a few economies here. On the left-hand side is, of course, the U.S., where we see two-year interest rates, even though they've bounced back a little bit since this chart was made. Two-year interest rates still are meaningfully below, about 100 basis points below what the current target rate is, indicating the fact that there is an expectation of relatively significant cuts. And in particular, in the U.S. case, a lot of those cuts are very front-loaded, with a relatively swift move down into the mid-threes happening over the course of the next 9 months or so. In addition, what we're seeing on the right-hand side is Chinese policymakers continue to deliver significant monetary easing in many different forms. Here, showing the rate on AAA CDs as well as the rate on the term lending facility. But really, all rates in China are clearly going down. And the PBOC and other government agencies have made a real effort to lower rates, particularly in the last few weeks, as part of their broader policy response. The thing that's unusual about this is the last time that we saw such significant global easing was uh, during a pretty tough time in the global economy, with the global financial crisis reaching its crescendo and forcing central banks globally to cut aggressively in order to support their economies. The dynamics today couldn't be more different, with global asset prices, global stocks pushing to all-time highs and continuing to rise, and global spreads markets pushing essentially to lows. This would indicate that global financial conditions are actually pretty good, pretty strong, and not necessarily consistent with the sort of financial conditions that you typically see during a large easing cycle. Economic conditions also remain pretty strong as things go. On the left-hand side, what you see is global real GDP growth, which has basically been stable at about 3% for the last couple of years, and not really showing many signs of decelerating further. And on the right-hand side, we show inflation pressures in a couple of the key developed world economies, where core inflation continues to be above target for most economies in the developed world. And so you're seeing this aggressive expected easing cycle coming at a time when growth is pretty good on a global basis and inflation remains elevated relative to targets. As we turn our attention to the US in a little bit more detail, what you see is on the left-hand side, pretty much every triangulation related to growth that you can have is running at about 2 to 3% on a real basis, and has been running that way for a few years now, quarter after quarter. And given the fact that interest rates have basically been in this range for the last couple of years as well, what this suggests is that even with relatively long and variable lags, the current level of monetary policy is insufficient to create a significant slowing of economic conditions in the US. On the right-hand side, we see an updated chart for GDP now for third quarter data, which continues to confirm growth that's in that range. The most recent prints that we saw today suggest actually a bit stronger, above 3% on this measure, given the recent data that has come in. So you're looking at this and you're saying, it's difficult to look at this set of data and say, given the interest rates have basically been flat for a few years, and really conclude that policy is very restrictive. But nonetheless, every day, various policymakers from the Federal Reserve come out in their various speeches and consistently use the term very restrictive. Now, I've seen very restrictive monetary policy in my career and by studying history. And I'll tell you that flat, pretty good GDP growth is not indicative of very restrictive policy. Further, asset prices and stocks and spreads basically at all-time highs for stocks and secular lows for spreads is not indicative of very restrictive monetary policy. So the idea that current monetary policy is very restrictive is theoretically supported, not empirically supported. And I think that's one of the key challenges that's going on today, which is that the vast majority of central banks facing these sorts of conditions would typically not engage in an aggressive easing cycle. And for whatever reason, the Fed has decided that current policy rates are very restrictive without the support of empirical evidence, and therefore are making the choice to cut aggressively despite the fact that conditions are okay. That's just the way it works. Sometimes, and in reality, what they're doing is rewriting the reaction function significantly in response, rewriting the reaction function significantly over the course of the last, 3 to 6 months. As a macro investor, that may look like bad policy making and may cause problems ahead, but you can't fight the Fed and you can't fight their policy decisions. They've made it clear what their reaction function is, and that's shifting towards accommodative monetary policy in the near future. Now, I think that's pretty interesting because underlying this is actually quite a strong growth environment, a very sustainable, strong growth environment, which continues to be financed by income growth. Now, for those of you who have been around these webinars and followed me enough, you've probably heard more about the income-driven expansion than you'd like to. And I think that one of the things that's pretty interesting over the course of the last couple of weeks since we last got together on one of these webinars is there's been a update in the various income and savings related data that suggests that the income-driven expansion is even stronger than we had previously suspected. On the left-hand side, what you see is compensation, wages, and salaries. So real cash compensation, not benefits and pension benefits and stuff like that. This is real cash compensation in the pockets of people through the second quarter, growing at something like 7% on a year-over-year basis nominal. That is very strong. And as you can see in the context, the last time we saw nominal wage growth growing at that pace was back in the 90s boom. And on the right-hand side, if we control for the number of employees hired, here I'm just using non-farm payrolls, which, if you think is overstated, no problem. Wage growth per worker is then even stronger than the acceleration to 5% nominal that we're seeing here. And that's pretty much in line in terms of what we're seeing across the board from various wage measures, that nominal growth continues to run at about 5% a year. And so just so happens that basically what's happening with spending growth is spending growth, consumption growth from households continues to run at about 5 to 6% a year in growth terms as well. And so that is a very sustainable set of circumstances. What was notable about the most recent data releases was that because of that stronger than previously held income growth number, what that suggests is actually that the savings rate is not falling in order to finance the spending growth that we're seeing. And that's important because it means that not only are households primarily sustainably spending out of their income growth, but they're also putting a little aside. And that combination of dynamics is pretty sustainable and continue on, for an extended period of time. And in particular, self-reinforcing, not a spiral, but self-reinforcing, because one person's spending is another person's income. And that income can then go to additional nominal spending. And so that dynamic can persist for an extended period of time. And it's the key reason why this economy has not been particularly sensitive to interest rates, because the interest rate parts of the economy, which are particularly borrowing oriented, haven't really been required here. Spending growth, nominal spending growth continues to grow just fine without needing considerable borrowing. And that's what you see over here on this left-hand chart, which is household borrowing continues to run at recession-like levels. This is not the type of expansion that looks anything like what happened in the 06 to 08 period. I always chuckle when I see people, saw people talk about the first Fed cut and the implications of the first Fed cut and compare today's dynamics to what was going on back in the 2008 cycle. And the 2008 cycle and today's cycle couldn't be more different. Back in 2008, credit growth had been running as high as 10% a year, 10% of GDP a year in terms of incremental borrowing. That was one of the greatest debt bubbles that we had seen in the Western world in the post-war era. And today, borrowing is running below 2% of GDP, totally different environments. And so trying to relate the cuts and the subsequent dynamics after the Fed's cuts today to the subsequent dynamics back in 2008 is a particularly foolish exercise, because the problem back in 2008 was not that the Fed was cutting. The problem was that the debt bubble was bursting. Totally different environment. And on the right-hand side, we're finally sort of getting an answer to that core question. A lot of people were asking whether gross domestic product or gross domestic income was better capturing what was going on with economic conditions. And while many doomers had suggested that gross domestic income was the primary best indicator of what was going on, the revisions to the data more aligned the income numbers with the production numbers, suggesting a continued pretty strong economy over the course of the last 8 quarters or so. Now, the transition to the easier monetary policy environment isn't going to take many quarters through all the cuts from the Fed to deliver the type of stimulation that can start to create further acceleration of this economy. Already, what we're seeing is meaningful declines in interest rates over the course of the last couple of months, which are already starting to have an effect on real economic activity. On the left-hand side, what you see is the 2-year interest rate, the year-over-year change in the 2-year interest rate, which has fallen about as rapidly as you see in the last couple of decades, really during periods where we had meaningful economic softness. And on the right-hand side, we're already starting to see meaningful declines in the 30-year mortgage rate at a pace of declines that is basically as fast as it's been in the last couple of decades. That has now changed. Just that move has sufficiently changed the economics to start to shift the choice between borrowing and not borrowing for many homeowners. On the left-hand side, what you see is we compare the 30-year fixed rate mortgage rate to the income growth rate. And this is a calculation that many households are doing when they're thinking about whether or not they want to take on additional mortgage debt. Now, in the U.S. context, in those two lines, they've gotten closer to each other as mortgage rates have come down, as income growth has been pretty strong. In the U.S. context, that mortgage rate isn't necessarily the best indicator of what the actual effective cost is of borrowing, because of course mortgage interest is deductible. And so for those homeowners who are borrowing and paying mortgage interest, the effective cost is about 2/3 of what the posted rate is because of the mortgage deduction, the interest deduction that they can take. And so that starts to create a circumstance today where, despite the fact that rates are somewhat elevated, the fact that nominal income growth rates have increased substantially over the course of the post-COVID period means that those mortgage rates, taking into consideration the post-tax effective rate that people are paying, are starting to become pretty compelling. And there's room for the mortgage rate to fall further, in part because a big driver of the mortgage rate being elevated has been as a function of the spread over risk-free rates. Now, that typically happens during one of two times: one, where there's a lot of interest rate volatility, or two, where financial intermediaries are feeling stressed. So you see that move around the GFC, where the spreads widened significantly. That was primarily a function of the fact that that financial intermediaries were particularly stressed during that period. The more recent rise has been predominantly related to the uncertainties of bond or long-term interest rate volatility, which indicates, which has started to come down as the path forward for interest rates has become clearer. And so the fact that the Fed has made it relatively clear that they're going to cut interest rates aggressively over the course of the next couple of years suggests, or is putting pressure on that spread to tighten. What we're also seeing is for businesses, this is also a compelling time for businesses to start to think about borrowing. Business borrowing has remained relatively contained over the course of the last couple of years, as well as higher interest rates have deferred incremental borrowing. And a lot of the CapEx investment that we've seen has been predominantly financed through cash flow. Well, the decline in yields that we're seeing here so far, have now moved the high yield interest rate, with the combination of the risk-free rate coming down as well as spread compression, to be not that far off of nominal GDP growth, which is, an unusual circumstance. If you look back through time, typically high yield interest rates are meaningfully above nominal GDP growth. And I use nominal GDP growth just as a simple indication of what top line revenue growth is, at the economy-wide level. And so there's some increasingly compelling reasons why businesses might start to pick up their borrowing, in particular, given the fact that there is a strong growth environment and that there's good reason for CapEx investment, particularly related to various technological innovations. What you see here on the left-hand side is, profitability has increased as well. The outlook for profits for companies are starting to increase. and that banks are starting to normalize their tightening of standards, in part because banks, haven't really done much over the course of the last couple of years. Balance sheets have been flat. Everyone was sort of all these banks were sort of protecting themselves in the post SVB period, and not much, frankly, has happened post SVB that is constrained, that should constrain banks from engaging in additional lending activity. And so you look at that picture, and what you see here is a lot of credit capacity that could exist in the economy. And look, you don't have to have a global pre-global financial crisis boom in credit borrowing in order to keep this economy going or have it tilt to running hot. Even a relatively modest amount of incremental borrowing by households and businesses in order to buy assets and invest could create, just enough incremental strength and conditions that will run this economy hot, because we're already running a relatively hot economy with unemployment running in the very low fours, and the GDP, the expansion being pretty, multi years in time. This over easy policy from a financial markets perspective basically favors gold and stocks relative to nominal bonds, should favor a steepening of the yield curve, and somewhat counterintuitively favors the dollar relative to foreign currencies. And let me explain. And that's basically in part what the market action is that we've been seeing over the course of the last couple of weeks since the Fed's announcement. Here I've marked these charts just prior to the Fed's announcement, so you can get a sense as to what the market action has been. They're a couple days out of date, so do keep in mind some of these things have changed. Particularly, stocks are doing a little bit better than what's on this chart. And what you see here is gold's higher, stocks are higher, bond yields have risen all the way up into the fours, and the dollar has strengthened, all in line with that over easy monetary policy. And the reason why you'd expect this dynamic to work this way is that by pursuing an over easy monetary policy in particular, you'd expect to see expectations of future growth rise. And so in the best way from the market's perspective to see that is stocks outperforming bonds. You'd expect to see gold rise relative to bonds because of expectations that the U.S. will be running a more inflationary economy ahead than what was expected, and that many foreign investors in particular will look for assets other than bonds in order to maintain a storehold of wealth. And we've basically seen that dynamic play out as well. You, of course, expect to see bond yields rise and a steepening of the yield curve, in part because the over easy monetary policy should bring down the short end of the curve and create a steepening of the yield curve as strong growth leads to increased credit demand and reduced desire to lend at existing rates, and creating that steepening of the yield curve. And then, of course, the dollar, a little counterintuitively, typically you'd expect an economy that was running monetary policy that was too easy to experience exchange rate weakness. But the U.S. in particular is sort of blessed by the position that a lot of the demand for our financial assets are really equity assets and equity oriented investment. And so by running over easy monetary policy and strengthening U.S. conditions, that is favorable for foreign investment into the U.S. The rise in bond yields is also favorable to the U.S. dollar, in particular, directly against Japan, but globally against other developed economies, to the extent that the U.S. is running hot and seeing a rise in interest rates. That is, on the margin, beneficial. Now, of course, if the U.S. were to run too easy a monetary policy, that could start to create questions about whether the dollar would maintain its storehold of wealth. But what we're seeing here is not an extreme set of behaviors. What we're seeing here is simply running conditions hot relative to what the underlying dynamics are at play. China has also been pursuing stimulus over the last couple of weeks, and notably focused on repricing their stock market. Now, we've talked about China at length and their deleveraging or depression environment, and how what we're seeing in China is a failure to deliver the type of monetary policy and fiscal policy and debt restructuring that's necessary to deal with the ongoing deleveraging. And that basic synthesis remains in place. So far, in the last couple of weeks, the efforts made by Chinese authorities have really been focused on what I call sort of an asset price easing rather than a macroeconomic easing or an economic easing for the economy. And so, in particular, that strength in the stock market has been really a function of a global short squeeze, short Chinese stocks, and created a heck of a spike on a short-term basis. But from a macroeconomic perspective, the Chinese stock market is irrelevant. No one, households don't have meaningful exposure to Chinese stocks, and very few foreigners have meaningful exposure to Chinese stocks. And so what you're seeing here is a real focus on something that, makes headlines and has it has high sentiment value, but has very little macroeconomic value. And that's frankly in keeping with the efforts that the Chinese policymakers have made, still focused on sentiment dynamics and not sufficiently focused on the key fundamental macroeconomic and bad debt dynamics that are necessary in order to create an economy that's moving out of this deleveraging environment. Further steps were taken, additional steps have been taken to provide access to borrowing in the housing market. There's lots of different nuances of it. For instance, the ability to borrow on second homes, lowering interest rates, uh, making down payments a little easier to do. But if you're in China, in your Chinese household, why the heck would you borrow a bunch of money in order to buy houses when the current level, the current price level remains the most expensive in the world, as you can see on the right-hand side, and prices are pretty consistently falling. And so I think that's the core, Chinese policymakers continue to run into the basic macroeconomic deleveraging problem, which is doing a bunch of supply side easing into an economy that's experiencing a demand problem ain't going to do much because the transmission mechanism is for people to actually borrow and buy those assets. But people aren't inclined to buy those assets as their prices going down, as the prices remain very, very high and the prices are going down. I mean, just in contrast, we saw in the US environment with massive easing dynamics going on. It took house prices moving down 30 or 40% in order to get buying. And obviously in Japan, which delayed its stimulation, we saw housing prices fall something like 40 or 50% before we saw a meaningful bottom in those prices. And so China is probably just getting started, in particular, because the current level of prices is so high on an absolute basis or relative to incomes. We probably have a lot farther to drop before that trade-off, that sort of speculator buyer of houses is going to come in. In addition, efforts to recapitalize the banks to provide about $150 billion of capital into the banks in order to help offset the bad debt problem are basically off by an order of magnitude. It's important to recognize that Chinese housing is the single biggest asset class in the world. And at this point, strong, like good measures of abandoned Chinese housing that are likely subject to default is something like $10 trillion of value. Now, those assets won't trade to zero, but $100 billion or $150 billion of recapitalization against $10 trillion of bad debts is a drop in the bucket. Until the Chinese authorities start talking about restructuring their debts on the order of trillions of dollars, we're not likely to see a significant resolution of the bad debt problem domestically. And the result is exactly what you'd expect, which is that, so far, the pressure for households to delever in China continues to be very strong, with the vast majority of households basically paying off their existing mortgage on an incremental basis, but not choosing to take advantage of these new lending programs. And the result is a challenging underlying macroeconomic environment. Here, I'm just showing the manufacturing PMI new orders, which I think, is a important, but not by no means the only driver of economic conditions in China. But what you see here is that the economic challenges that China is facing are much more substantial than the policies that are being done, regardless of whether or not stocks go up 10 or 20%. And I think we got some indication today that policymakers' efforts, uh, you know, they basically they said they were going to do a big announcement. A variety of different policymakers came to the table, including the governor of the central bank. And the result was 100 it was 100 billion yuan pull forward of government spending and 100 billion yuan of incremental construction activity. That is in total something like 0.15% of Chinese GDP in aggregate on those two planned programs that were intended to make a big splash. That's essentially like saying that you're going to create a great deal of stimulus for Scranton and hope that the rest of America is going to be able to surge as a result of that. And that's just not how it works. The orders of magnitude from these policymakers in terms of their policies continue to be off. And the market action that you saw in response, down 10% in Hong Kong stocks, is a good indication of just how disappointing this level of activity or level of stimulus was today in the announcement.